In previous videos, I explained the investment costs that can be capitalized, and I briefly explained the depreciation methods. So as I explained, there are four major depreciation methods. First one is a straight line that I'm going to explain in this video. Second one is declining balance. The third one is declining balance switching to the straight line. And the last one is modified accelerated cost recovery system, or MACRS, that I will explain in the next videos. Straight line depreciation is the simplest method in calculating depreciation. In this method, we uniformly distribute the depreciation over the years of allowable lifetime of the property. So the equation is the cost of the asset, the capital cost that we pay for the asset, minus the salvage value, if there is any salvage value, divided by the number of years that we want to depreciate that property over those years. So this method is very simple, but the problem is it is very slow. As we explained before, the investor would like to recover the capital cost as soon as possible. The more years, the longer it takes to recover the money. So they get the same amount of money every single year. They get the same amount of depreciation every single year. So, and we know that the faster costs are recovered, the lower tax is paid in the early years, and it is going to enhance the economics of the project. The earlier the investor gets the tax deduction, it improves the economics of the project. So let's assume an investor pays $100,000 for a machine, that this investment can be depreciated using the straight line depreciation over the 5 years from year 1 to year 5. The machine will start producing and generating revenue from year 1 to year 10 with the revenue of $38,000 and operating costs of $12,000. The salvage value is going to be 0, and also the investor has to buy a land for cost of $25,000 at time 0. But because land doesn't lose its value over time, we assume the land resale value in the end of the year 10 is going to be $35,000. So we consider the income tax of 25%, and we want to calculate after-tax cash flow. First, we need to calculate the depreciation. The capital cost for the machinery was $100,000, and it can be depreciated over 5 years. And with a straight line depreciation, we have 5 years of uniform distribution, and the salvage value is 0. So the depreciation for each year is going to be calculated as $100,000 divided by 5 years, and we are going to have $20,000 of depreciation for each year from year 1 to year 5 that can be deducted from revenue as tax deductions. Here, please note that the land is not depreciable. So the land is purchased for $25,000 at present time, and it is going to be sold at $35,000 in the end of the year 10. So the investor is going to make $10,000, which is the difference between the purchasing cost and the resale price. The investor has to pay tax on the $10,000 of profit that is going to be earned at year 10. And now the second step is we draw this table. We start with revenue, whatever generates income. The first is we have $38,000 of revenue created by the machine. Then we are going to sell the land at year 10. So we are going to have $35,000 of cash after we sell the land in year 10. But we can see I'll show you later in a bit that just $10,000 of that has to be taxed. So then we start adding costs. The operating cost of $12,000 from year 1 to year 10. Then we add depreciation. So the depreciation should be, we should enter depreciation with a negative sign, and it has to be deducted from revenue as tax deduction before calculating the tax. So we have 5 years of depreciation, and it is uniformly distributed. Every year is $20,000 we deduct from revenue from year 1 to year 5. And this item called write-off, because we are going to sell the land at $35,000. We are going to have the revenue of $35,000 at the year 10. But we pay $25,000 for land at the present time. So the profit that we made on the land is taxable, and not the actual capital cost that we pay for the land. So we write this land write-off of minus $25,000 to adjust this income, that saying that, okay, just the $10,000 of the money that we made on the land is taxable. Then we calculate the taxable income, which is the summation over each column. And the income tax of 25%, which is the 25% of taxable income. And we calculate that for every column. And what we have is net income, which is the summation of these two rows. If we enter the tax with a negative sign, this is going to be with the summation. If we don't enter the tax with negative sign, then it will be the difference between these two. So taxable income minus income tax is going to give us net income. And we calculate that for every single year from year 0, from present time, to year 10. Here, because we don't have any income or any cost, we don't have any net income at year 0. But later on, we will see that we are going to have our capital cost and land cost here at year 0. So then we start adding back whatever we deducted here for tax deductions. So we deducted this depreciation, we calculated the tax, and then we add that back again. So negative sign here, and then we add that with the positive sign. These are exactly the same. The next thing is land write-off. We add back the land write-off of $25,000. And then we enter the capital cost. So the investor invested at $100,000 at present time for buying the machinery, and the land, which was purchased for $25,000. Please note that For the write-off, we have a minus number here before calculating the tax, and we add that back again. And here we have the resale value of the land. And we calculate the after-tax cash flow by making a summation over each column. Net income plus depreciation plus write-off minus capital cost minus land. And this is going to be our after-tax cash flow. So let's work on this example in a spreadsheet and see how we can use a spreadsheet, Microsoft Excel or any other spreadsheet to approach these problems. So first I'm going to write the year. I start from year 0. There are 10 years. The lifetime of the project is going to be 10 years. So I will have 10 years of project lifetime here. Then the first thing that I have to do, I start with the revenue, with the items that have the nature of making money, creating some revenue. So revenue that is generated by the machine. Machine comes to production at year 1 and produces from year 1 to year 10 and generates $38,000. One important point here is you have to have all your input data in a separate section, and you have to refer to those cells that you need. And very good feature about the spreadsheet is if you update some inputs, it is going to automatically update your output as well. So instead of writing $38,000 from here, and to year 10, I will just refer that to the input data that I have here. So I write equal sign and this one, and because so it writes the $38,000 here, but because I want to apply this to the other 10 years, I will put a dollar sign before the column number. Then when I apply this, it keeps the year keeps the same cell for all the years. So there is no revenue at year 0, so I skip that. I left that blank. Then I'm going to have land resale value. Excel is confusing this as a equation, so I can just delete the because I start with a positive sign, so I can just put this sign and it will accept it as just a text. So the land resale is going to be $35,000 at year 10. Then I will add the operating cost with the negative sign. Operating cost. So I'm going to have the operating cost from year 1 to year 10. So negative sign. I read the operating cost from here. I fix the column number and then apply that to year 1, from year 1 to year 10. Then I'm going to have the depreciation with the negative sign. Depreciation. I can actually calculate the depreciation somewhere here and refer to that cell. I can say year depreciation year 0, 1, 2, 3, 4, 5, and the depreciation equals the capital cost divided by 5 years of depreciation. So I fix this one, and this is a straight line, so I'm going to have $20,000 per year from year 1 to year 5. Sorry, I don't have depreciation at year 0. So I'm going to enter depreciation with a negative sign here. Year 1, year 2, 3, 4, and 5. And I will add the land write-off. With the negative sign. Then I will draw a line here because I want to calculate the taxable income. So taxable income, I have to make a summation over each column. There is nothing at present time. So summation of all these values at year 1, and I apply that to year 10. I calculate the tax with the negative sign. So that is going to be 25% of this amount. 25% of taxable income, and I apply this to year 10. Again, I draw a line here and I calculate the net income, which is going to be I could have the tax with the positive sign and then deduct these two, or I could have the tax with the negative sign and just simply make a summation here. So I will enter the tax with the negative sign and make a summation here and calculate the net income. After we calculate the net income, we have to add back whatever we had here as the tax deductions. So we had this depreciation and we had land write-off. So we add them back with the positive sign. And it is exactly the same as here, so I will just multiply this number with the negative sign. This is for 5 years. I apply that for 5 years. Then the land write-off with the positive sign, which is going to be at year 10. And we are going to have the capital cost with the negative sign. So the capital cost was happening at the present time. So negative, and I read it from here, and we paid for land at present time. So land again, I draw a line here because I want to calculate the after-tax cash flow. And after-tax cash flow is simply the summation between these two lines. So now I have the after-tax cash flow calculated in this row. Okay. There is a version of straight line depreciation method that is called half-year convention. So in this method, it's exactly same as the straight line depreciation, but we move everything for 6 months forward. So the intuition behind that is it takes a while maybe to for the machinery to come to production. So we start in the middle of the year, not in the beginning of the year. So we move everything for 6 months forward. So we take 6 months from the first year and we add an extra year to the end with only 6 months. So for example, if you want to calculate the same the depreciation for the same example, investing $100,000 in the machinery, using half a year convention, we just move everything for half a year to the forward. For the straight line depreciation, for each year we had 1/5 because we had 5 years of depreciation and the salvage value was zero. So $100,000 divided by 5. For each year we are going to have $20,000 of depreciation from year 1 to year 20. But if we use the half year convention straight line depreciation for the first year, we are going to have half of the depreciation. So we are going to have half of the $20,000, which is $10,000, which means that we have just 6 months in the year one, and we add that to the last year. So we are going to have one extra year in the end, and we are going to have add this 6 months to this. We are going to have this extra year with only 6 months. Again, the summation here is exactly $100,000, and the summation here is exactly $100,000. Please note that with half year convention, we have one more year here. So if we want to apply this half year convention straight line depreciation to our spreadsheet, we come back here. We are going to have one more extra year here. So we divide this by 2, which we are going to have 10,000 years here, $10,000 here, and we are going to have this $100,000 divided by 5 divided by 2 here. Again, if I calculate the summation here, it should be exactly same as $100,000. We go back here to this depreciation. We can see it is updated from here, but because we are going to have one more year, I need to apply these to one more year. And here I'm going to apply add that to one more year here. So we have 6 months less here, but we have one more year here with another with extra 6 months.